Right, well, good morning, everybody, and thank you for taking the time to attend our client update presentation. You might wonder about our timing. We had our last one in June, just before the end of the quarter, and this one in December, just before the end of the quarter, and we just think that makes sense for us and for our clients. We have a number of, many of our clients, in fact, more than half our assets are now from Europe, and the other half in South Africa. And so that just, in July and August, Europeans are taking holidays, and in January, South Africans are taking holidays. So the year's almost done. One never knows, but thanks for taking the time this morning to attend the presentation. Just a couple of things. You're welcome to ask questions, so feel free to add them. They will be anonymous, so don't feel shy. And I have with me today Andrew Lapping, our Chief Investment Officer, and Hal Bevan, our Head of Operations. And I'm extremely lucky to have these fine gentlemen as part of our team, both superb individuals, people of high integrity, and wake up and spend every moment thinking about how we can improve our client experience. So thanks, Andrew and Hal, for joining. And we're going to jump around. I'm going to start off, and then we'll jump around between us so that you get to get the input from both of us. Right. So let's go to the first slide. And then also, obviously, just goes without saying, but none of this is advice. We're trying to be open and transparent here. Please don't consider these as stock picks, and be aware of all the usual disclaimers. So this is year to date up to the end of November, and of course people want to know about year to date. We also have 1, 2, 3, 5, etc. And in dollars, we're up 36.
Sean, are you sharing? I can't actually see the screen, but that might just be me.
Sorry, Andrew. Okay, thank you for pointing that out. There we go. Rise up better. Thanks.
Perfect. Thank you.
So we are so year to date, in dollar terms, up 36.7 over the last year, 35.3. World Index is up 20, and the Investment Association Global category, which is some 545 funds for the year to date, is up 17.7, and that puts us in the 5th percentile. And you can see the percentiles going back through time, and $100 invested upon inception is currently worth $720. And the important thing about this is, if you think about what's happened since we started, we've had the global financial crisis, European financial crisis, Fukushima, we've had the pandemic, we've had the Ukraine invasion, etc. So you've had Trump tariffs, and we've managed to compound. And that's because in every crisis we try and find the opportunities. Okay, so let's just have a look at that 36.7 and how does that reconcile? Well, our winning positions contributed, and this is in basis points, so this is 1% is 100 basis points. So our winners have contributed just under 42% of performance. The losers have detracted 7%, and that leaves us with a net contribution from our equity holdings of 34 and just over 34.5%. And then you've had dividends, fees, other costs like transaction costs and foreign exchange, because this is obviously in dollars, and you get to 36.7%. Now, if we have a look at the winners and the losers, and we'll break those down a few slides on, but importantly, the top 10 winners contributed 12%, just over 12%, okay? And that is only 29% of all the winners. And the top 10 losers detracted 5%, which is 77% of the 7% that's detracted. So what does that actually mean? What that means is we are not very dependent on one idea. You could have had good performance from one or two stocks. Let's say you'd owned NVIDIA in recent years. Well, then for clients, the concern then is, well, how do we know you're going to choose the next NVIDIA? But with us, because we have a very diverse portfolio, we're not totally dependent on one or two winners. And you can see that with the top 10 winners. And if we actually have a look at the sectors, you can see that, again, this is in basis points. The financial sector contributed just over 12% of the just over 35% or whatever, 35%. And so that's about 36% of our total contribution came from financials. You can see consumer discretionary, about 9% right the way down. We haven't had holdings in real estate or utilities, but this is where the contribution has come from. And what's perhaps useful for many clients is this is very different to the world index. We'll know that technology has contributed significantly, communication services, and indeed even utilities have had a good run this year. And so our contribution is from different parts of the market. If you look at this is our positions and the contribution in basis points. And what you can see here, this is the winners. So above zero is obviously the winners, and then the losers. And try as we might, we like to try and admit where we got something wrong, and we know that every large loss was once a small loss. Unfortunately, sometimes a couple of fish get away. But what's important to highlight here, I think, is that we've had 37 positions that have contributed more than 0.5% to performance, okay, and only 3 that have detracted more than 0.5% performance. And really, that speaks to it. So as long as we have more winners than losers, and when we win bigger than when we lose. Then when we compound that through time, that'll be meaningful. And we've had eight positions contributing over 1% and 2 positions detracting 1%. Okay. So here's a list of some winners and losers. And Andrew, you're responsible for many of these winners. Do you want to take us through?
And some of the losers. Thanks, Sean. Yeah, I mean, I suppose the first thing that's interesting about some of these, most of those winners, we no longer have them in the portfolio. So maybe you've heard of Alibaba and Baidu. Those are 2 Chinese technology stocks. China went from very much out of favor to only somewhat out of favor in the last year, and we took advantage of people being very negative on China, and you had a chance to buy these fantastic technology stocks at very, very reasonable prices. We're talking single-digit PE multiples compared to what technology costs in the rest of the world. Fortunately, people saw some of the value. We took the rewards and we exited. And ABN AMRO, obviously a big bank, and people know from 18 months ago we had lots of European banks. We had 5 or 6 European bank positions. European banks were extremely out of favor. And you could buy things like ABN AMRO on 5 times earnings. I think we just lost Sean. Sorry, I beg your pardon. Let me just share my screen. And where's my presentation? Share it. Okay, sorry, let me scroll down to where we were. Here we go. You had, I think, lots of European banks trading very reasonable valuations. Suddenly people love European banks and we rated sharply. We've exited all our European bank positions, and they now, we think, pretty fully valued. We do still own banks. We own some bank positions in Thailand. We own some banks. We own some banks in Eastern Europe, but far smaller in the portfolio. Sally Beauty is a hair care retailer in the States that went from very out of favor to only somewhat out of favor, did nicely. TV Asahi, a Japanese television company. I mean, but more important for me is what did we get wrong and what do we think about that? Biggest attractor is Sappi, which is a paper company listed in South Africa. They do business South Africa, Europe, and the States. And I think that we still own the position. The big thing that's important there, what we got wrong. It's a cyclical business. We thought we were towards one of the cycle when we invested. The cycle got worse and longer. But what hurt us is we did break one of our rules, and that's buying a company with debt. So Sappi does have debt, and hence the downside is always worse. B&M is a low-cost retailer in the UK. Mid-cap UK stocks have been very out of favor, and there are certain government policies which have hurt UK companies, particularly ones that have space. So in the UK, they've had big increases in the minimum wage, in national insurance, in effective property taxes, which have hurt these businesses. Do we still think it's a good business? Yes, and we still own it. And then Teleperformance, that is one we semi-changed our mind on. It's a business processing outsourcing business, which was obviously under pressure from AI competition. We still think they may benefit by implementing AI for their clients, but nonetheless, it hasn't done great. Soup, we still own and are still buying. It's basically the Twitch of South Korea. So it does streaming of gaming and so on, which is it's extremely cheap. Let me just say that. Trades on 7 times earnings, half the market cap in cash. And Korea is an interesting stock market because buying stocks in Korea is actually very difficult. You have to open a direct account. You've got to pre-fund the account. So actually the competition in Korea is very little, and Koreans love the States. So actually Korea has been a very happy hunting ground for us in the last year. So just talking about how we manage risk, and this is extremely important for us. Why? Well, one of the most important reasons is both Sean and I have a large portion of our savings in the fund, and neither of us like losing money. So we do a few things. We have small positions generally, no single large positions. So Sean talks about it as the millipede approach. You can lose a few legs and you carry on trucking. We are very price sensitive when we invest. We're not paying for super upside. We're not paying for hope. We're paying for reality. We're paying for cash flow. We're paying for history. We're paying for businesses who have a track record of great performance. We're also very diversified. You'll see later, we've got an equal weighting pretty much across the world, whether that be the US, Europe, Asia, some emerging markets spread across the world. We also look for businesses that are well run, strong cash flow, pay dividends, and strong balance sheets. This gives us downside protection, and that's why it's quite upsetting that we erred in Sappi, a company with debt. And then just terms of liquidity, we are a very small fund, we are minnow, but we like to be able to enter a position easily and not affect the price. And if for some reason we change our view in the stock, we like to be able to exit easily. And therefore we look for liquid positions. We've never, even when we were tiny, we always had a limit that a stock has to trade more than $4 million a day for us to invest. And you can see this in the table below. If for some reason we decided to liquidate the portfolio, trading just 10% of the trade that happens in a stock per day, we could sell 30% of the entire portfolio in a day and 70% of the portfolio in just 5 days. So very liquid and easy to exit. So I see Sean has returned, that the UK internet has returned. So he can carry on and talk about this slide.
Thanks, Andrew. That was only supposed to happen during the difficult questions. Okay, so just to touch on and you can control the slides from here, right? Just to talk about this risk of downside capture, and what that is basically Morningstar has a look and goes back and says, how has the fund done in positive months? Okay, so and then that is called your upside capture. So it's your performance during positive months, and your downside capture is the percentage of the performance that you capture during negative months. And obviously, months can end a few days earlier, a few days later, and the numbers are different. And so the longer the return that you look at in terms of upside downside capture, a more accurate picture evolves. And so what is this saying? This is saying that over the last 10 years, in positive months when the market is positive, we have captured on average 89% of that positive performance. But when the market has been negative, we've captured only 77% of that negative performance. And that really is that really is what we want to do. Compare that to the peers, IA Global, where it's also less than 100%, but in terms of downside capture, it's more than 100%. And so if you, on average, don't have to capture all the positive performance, but you capture less of the negative performance and you compound that through time, that is really the winning formula. And so that's what we try to achieve. Okie dokes. And now we got a question recently. You can see a similar chart on Morningstar's website or the FT's website. And that was, well, how does your volatility compare? Now, we don't consider volatility to be a great measure of risk, because we all want positive volatility. We just don't want negative volatility. And that's why we prefer upside and downside capture. But what you can see here on the y-axis is the 3-year return. And then to get more data points, we've used weekly rather than monthly, okay? We haven't used daily because you've got funds from all around the world and you've got Thanksgiving holidays and all of that type of thing. So we thought, well, let's just go with weekly. It gives us more data points. And so we've got volatility over the last 3 years on a weekly basis. And where do we stack up? Well, you can see we're up there the dot up there at the top, and the world index, so the blue dot just above the word world is where the world index is. And what this is essentially trying to show you is your return versus your risk. Again, obviously you've got positive volatility and negative volatility in here. And it just shows that our volatility is slightly higher than many of the peers that we respect, pretty much in the middle of the pack, really. Our return is higher as well. And then you have a few outliers with far higher volatility on the x-axis. But as I say, if you want to go and have a look at those, we can't disclose the names of the funds. If you go to the Financial Times website and you hover over the dots, you can see the names of the funds. So for anyone who's interested. Okay. Top 10 holdings, Andrew.
Let me touch this. So a couple of things on the slide. Well, firstly, on the left, we've got the top 10 holdings of the fund now, and the right, you can see the top 10 holdings of the fund a year ago. And why are we showing the top 10 holdings from a year ago? It's because, like, some people say, oh, your fund has done nicely. I don't want to buy stocks near the top. All your stocks have done well, and I'm just buying stocks that have gone up. So what you can actually see is, I would say, there are only 2 stocks that we held a year ago that we still own. The rest are gone, sold. Why? Well, because we own these positions. We thought they were undervalued. They appreciated, which is fantastic. They then approached our view of fair value, so we sold them. If something for us approaches fair value, it's gone from the portfolio, and we take that money and we invest it in something else, which is trading at a discount to fair value. So ABN AMRO gone, BNP Paribas gone, Alpson's gone, etc., etc. So now you look on the left, what we hold now, and a few things about this top 10. The first thing, you can see this diversified portfolio. Top 10 only accounts for 22% of the portfolio, largest holding 2.5%. So if for some reason one of these stocks turns out to be not a great investment, the downside is limited. The second thing is it's an actually diverse, different portfolio. If you want to buy Amazon, if you want to buy Microsoft, if you want to buy those big stocks, go and buy a MSCI World Index Tracker, which is very cheap. If you want to search the world, trying to find individual undervalued stocks, which for some reason people don't like, or have been ignored or thrown out the bathwater, that's what we do. So if you look at this portfolio, you see stocks from China, something like Haier Smart Home, which is actually a very big company and one of the fastest growing manufacturers, producers of white goods in the world, including air conditioning, fridges, washing machines, etc., spending huge amounts in R&D, basically crushing the Western companies which have been skimping on R&D. Then you've got things like Greggs, which we'll chat about. Mattel fell out of favor with the tariffs. They obviously make games. We think management make toys. We think management is doing a great job leveraging the intellectual property into videos. You've seen the Barbie movie. I guarantee you there's going to be a Barbie 2, there's going to be a Barbie 3, which they'll benefit from. And then right at the bottom, you can see something that we've been started investing recently, and that's Diageo. And we actually own quite a few of these drinks companies now. We own a bit of Diageo, we own a bit of Pernod Ricard, we own some Carlsberg. And if you had said to me 5 years ago, do I ever foresee us owning something like Diageo, a kind of consumer staple, which we're very much loved, traded 25, 30 times earnings? I'll say absolutely never. No way. These stocks have fallen totally out of favor. And actually, if you look at Diageo on a forward earnings basis, the last time it traded on this forward PE, which is about 12 and a half, was in 2010. Okay, so people have really lost faith in these businesses. They think people are going to stop drinking, etc. But human nature doesn't change easily, and people enjoy a Scotch whiskey from time to time. So we think these are strong brands. We think there's lots of growth in India, lots of growth in Asia still to come. So we like them. So a different portfolio of undervalued stocks. You'll see there are some American companies in there. Comcast, a very recent acquisition, just bought it last month. Travel and Leisure and United Health Services, also US companies, but not particularly well-known ones. Let me chat to Greggs before so this is our top 10, a top holding for us. And why do we own Greggs? There's nothing we love more than a great business that's fallen out of favor. management doing the right thing, management looking after our interests, growing the business, strong competitive position, very strong balance sheet. What more can you ask for? So this is a company, grown revenue, return on assets of 12% on average the last 10 years, growing revenue at about 10% a year. Fantastic value. A Greg's coffee in London costs approximately half of what a Costa or a Pret or Starbucks coffee costs, and actually it tastes pretty much the same to my mind. There's lots of growth potential. You're offering value to people. You're offering a unique proposition. But what's happened? People have become concerned. So if you look at the bottom chart, those green bars are the earnings. The red bar on the right of the red bar is consensus forward earnings. So earnings you can see in 2025 have fallen. However, people do expect growth to resume. So why have earnings fallen? Oh, for a few reasons. The first one is, I touched on it earlier, the government last year put up the minimum wage quite a lot. They increased the national NHI contributions for people. So staff costs for Greggs went up a lot. They also increased the property taxes, so occupation costs went up a lot. So that big cost pressures, they haven't passed these on yet because they're obviously a value proposition. So earnings come down a bit. But if you look at that dark black bar, the price, so here you can see Greggs, the share price in 2025 of about £16 is back where it was in 2019. Okay. However, in 2019, it was only earning about 70p per share. It's now earning 120. Let's just say consensus is right, 120, 125. So earnings nearly doubled, share price back where it was, and actually from the peak when the share price was over 30, share price has halved. The business, we think, is actually in a stronger position than it was a few years ago. They've invested wisely, building a new supply chain, building new production, growing, leaning up, improving the value proposition. So actually, we think you're paying half of what people paid just a couple of years ago for a great business. And it pays over 4% dividend yield. So just as interesting a comps between Greggs and Starbucks. So revenue growth, last 10 years, Greggs has outgrown Starbucks, outgrown on an earnings point of view. Fair enough, maybe people think Starbucks earnings are low. But here, on a forward earnings basis, you can buy Greggs at 12.5%, 12.5 times forward earnings, 4.2% dividend yield. Who would, that's what you get from bonds, but it's growing in your pocket, 4% growing dividend yield. What more could you want as a long-term investor compared to some people want to pay 33 times, earnings for Starbucks? So, this is the type of thing we look for. Unloved, short-term negativity for a great business.
Perfect. Thanks, Andrew. And I think also that leads nicely into why we underweight North America. If you look at our weightings across regions, you can see when you've got companies like Starbucks on 33 times earnings and Costco on 50 and Walmart on 45, it's not just some of those technology companies we all think about which are expensive. Actually, many of the second tier companies are extremely expensive. And so we just look around the world. We don't care where they are. We don't worry about the benchmark. We're only interested in growing wealth in real terms, and we invest in value propositions. Okay. And so that is how our weighting is arrived at. And now many people would say, oh, but that's quite risky. You massively underweight North America. We don't consider that risky. We think in this current age, we wrote about it in our fact sheet, with changing global political allegiances and trading patterns, etc., it makes sense to be broadly diversified. And so that is our geographic allocation built from the bottom up. Why have we got a big weighting in Asia? Because we're finding lots of great companies like Haier, like Yuyen, etc. Okay, and this has changed. I mean, those who've been following us for a while will know that our weighting in Europe was larger a year ago when we had the ABN and the BNPs and the European banks. And so as we've taken profits, and that's why we will only have one fund, global equity fund, because it gives us the flexibility to move around the world depending on where we find opportunities. You'll see our cash holding is just over 6%, so that has been coming down. And we've always said, a couple of months ago it was about 10%. We said we'll wait until there are opportunities. We've been working on some ideas, And one of those ideas was Comcast. We like Comcast. We can put some money to work. And so that's how we will manage the cash. It's not a call on the market. And if you actually look at you look at the valuations outside the US, outside the large US growth, they're not really far away from from long-term averages. Okay, so don't consider. So if we have higher cash from time to time, it's because we've taken profits in something, or we've got an inflow and we're just waiting to deploy it in the best opportunities. Okay.
Sorry,
No.
I'm not very good at driving this machine.
And when you build the portfolio from the bottom up, and you look at the overall portfolio valuation metrics, you can see our fund has some 9 times earnings, which is, it's less than half of the MSCI World Index. And when you look at the kind of companies that we've got, Andrew spoke to Greg's, these are, better than average. We would say far better than average. And if you can buy a better than average portfolio, growing over the long term faster than average at substantial discounts to the market, it's a good thing. And that's what you want to do. Okie dokes. Now, this comes from Morningstar data, and we often get asked about the size of the companies in our portfolio, etc. And small means different things in different places. Mattel is considered a small company in the US, even though it's a $6 billion company. Okay, and so what Morningstar do is they divide each market, and the largest third is large companies, the middle third is mid-sized companies, and the smallest third is small companies. And so this is using the Morningstar categories. And if we just compare it to the World Index, over 70% of the MSCI World Index is in giant and large companies. That compares to around 30% for us. And only 20% is in mid and small, and that's where we're finding value, and we're over 50% of our weighting in that. Why are we finding value there? It's because of the rise in passives, which is going largely to the large companies, and they're at the expense of the mid-sized companies. You think about Greg's, why is it out of favor? Well, it's a 1.6 billion pound company. It's in the FTSE 250. People are worried about the UK consumer. They're not interested in small companies because they're being ignored by the passives, and that's how those kinds of opportunities arrive. Okay. Now, what's interesting is every now and again, if the economy is tough or conditions are tough, some of the giant and large companies can acquire small and mid-sized companies, and that's how they grow. They strip out the costs, bolt them on, etc. And during the year, we had a number of our positions were acquired. So we had Skechers got taken out, and by some opportunistic funds after the Trump tariffs. And we also had Foot Locker being acquired by Dick's Sporting Goods. And Foot Locker, we had a 1% position. It was acquired, had 100% premium to the price we paid only a few days later. And so that contributed, that was one of the positions that contributed more than 1%. And so actually being in these positions where in the mid-sized companies leaves you exposed to any potential corporate activity. Okay. Do you want to talk about this, Andrew?
Sure. I mean, as I said, that the fund has grown, and thanks to you who have supported us. We really appreciate our client support. We now approximately 2 billion, but in truth, that's still an absolute minnow in global schemes. And just to give you a sense that we're not running out of options. In terms of the average ownership, on average, we own slightly less than 0.5% of the businesses we invest in. For context, we've never invested in companies less than $1 billion. But even if you invested in a company of $1 billion and you bought 5% of that company, which is not a lot, that's still a $50 million position, which if you had a $5 billion fund, that's a 1% position of fund, which for us is a kind of normalish position. So they're still huge. And I think there are 10,000 stocks in the world who've got market caps of more than $1 billion. And there's something like 8,000 stocks in the world that trade more than $4 million a day. So we definitely not running out of options. Also, don't forget, we're not where everyone is. We are not in the crowded spaces. We Mr. Johnny Lonely. We off looking at stocks where no one else is looking. We take small positions. So in terms of capacity, for sure, we don't feel limited. at all. And if people decide to give us more money, that's fantastic. But for us, the most important thing is we've achieved now of growing scale. And the most important thing about that is it means costs are lower for our investors. So our total expense ratio used to be, close to 1/1. And now with our reducing fee structure and also putting some of our costs over a bigger denominator, we're very happy that our total expense ratio have fallen. And that's the number one benefit of being larger. Basically, the fee falls for our clients, which is fantastic.
All
Sure.
right, super. Thanks, Andrew. So we're coming up to halfway, and that leaves lots of time for questions. So I guess we've got two more slides. The first is, in summary, you've heard from our discussions, and those who know us, we invest differently. We don't worry about the benchmark. We invest differently. We're just looking for value and just to grow our wealth in real terms. We also charge differently. You charge our fees. We don't have performance fees. We lower our management fee as we grow, giving back some of our benefits of scale to clients. And some of you might not know, but we also give back differently. And so over the last couple of years in the background, we've been working on this. We empower some small charities, supporting the small charities and helping them do amazing stuff. So supporting our communities, supporting our clients, trying to make a difference in the world. So that's, and then the final slide, we've got a discipline process, which we have been doing and running since inception. It's proven itself through many market cycles, some of those events I spoke to earlier. That process has generated real returns at a time when value hasn't been in vogue. So we've managed to sidestep some of the value traps, not all of them. As I said, a couple always get away, but we've done that with a portfolio that's diversified and different. I mentioned the fee, and I think an important point, because there's always going to be storms out there, and what we do is we look for the opportunities in every crisis. When we had the Trump tariffs and the markets fell, we noticed a number of there were some redemptions from some of the platforms. Those poor investors who redeemed or didn't reinvest, ended the year and they were flat on the year. They've missed out on the performance. And so when a crisis comes along, just know that we will be out there looking for the opportunities, looking for the innocent bystanders. So maybe we conclude there. I see we've got a lot of questions. Howell, do you want to fire away?
Yes, sure. So a lot of questions on a similar theme, which I think Andrew addressed in the capacity slide, but AUM has grown. How does it affect the investment process? And also, is there a level of AUM at which you'd close the fund to new investments?
So I think just firstly on that, one important point is if you think about value investors, typically value investors buy too early and we sell too early. And actually, we sold our European banks too early. It would have been great to have had more money and a bigger position in European banks. As I say, paying a percentage of a bigger fund, it would have taken us longer to sell. We would have sold more into the rally, etc. So bear that in mind, that this is not a momentum type strategy where the more the assets increase, the harder it is. As Andrew mentioned, there are many of our respected peers who are multiples of our size. So we don't see an issue. And also, if you think about it, this year, we have grown assets a lot. It hasn't held us back. From the beginning of the year, we're much larger now than we ever have been. It hasn't dented our performance. We're having a banner year. So anything you want to add?
Two things just follow up. Our process has our process changed? No. But every week or all the time, we're thinking how we could become better investors, make fewer mistakes, improve our process. So we're constantly trying to incrementally improve. And that's why Sean and I speak about our mistakes, what we got wrong, how we can improve the whole time. And then the second part of that question was, can we close? And the problem is we can't really close because we're on all the platforms. You can't just close. It's not physically possible. I mean, the good thing is we're very niche. We're not for everybody, which means I think our kind of target market is very small. So, it's fantastic. We've had great success. And I thank our clients. But, I don't think we're likely to get very big. And, even so, if we do grow a bit, we don't think it's an issue in terms of the available universe.
And just one last thought there. There have been lots of people who said, can we market your fund in various other regions? Can they, we've had salespeople approach us, can we come and market your fund? If we were only interested in growth, well, we would have taken that on board. We're not. So we're containing our growth in that regard as well. We're not out there on a massive asset grab, hiring lots of salespeople, marketing in new regions, etc. So
we've got one salesperson. We've always had one salesperson.
Yeah. Okay.
Okay. So next question. Do you have a process to determine when to sell your losers to ensure you cut them early?
Yes, we do. It's not a price. We don't have a stop loss in terms of price. So that's quite important because, we get asked, do you have a stop loss? Well, if you had a stop loss of 10%, you would have sold your entire portfolio in the Trump tariff chaos. Okay. So what we like to do, or what we do, our process is to revisit ideas. So every time a company reports, we analyze it and we say, okay, if we didn't own our position, would we buy it today? That is the clear process we try and go through, and obviously if price has responded, if there's a sudden move, it's okay, well, let's not get emotional about this. Let's think about this clearly and rationally. If we didn't own this position, would we buy it today? What do we think the expected return is? Where's that coming from? Is it coming from dividends, earnings growth, re-rating, etc.? But we prepare to be patient, so sometimes these positions, it takes longer for the thesis to play out. Sometimes they don't play out, etc. But importantly, we don't do just an X percentage stop loss. And I think that also speaks to, we spend a lot of time talking about what we've got wrong, and we that's why we put our names up there. We know that we're going to get things wrong. We just want to get more things right. And so you've got to be careful not to have the knee-jerk reaction. A great point is we lost 11% in Russia. Had we turned around and said, right, that's it, no more emerging markets ever, well, we would have missed out on Korea this year. We would have missed out on Brazil. We would have missed out on companies like Halleck Bank, etc. So you've got to be very careful not to make these knee-jerk reactions and get emotional at the time when everybody else is getting emotional. You want to take advantage of that. Is there anything you wanted to add there, Andrew?
All good. No.
Yeah. And sorry, one other thing. It's open season on all stocks. There's no sacred cows here. So if there's a company that I've got which is not, and it's troubling Andrew, he's at total liberty to say, okay, I'm going to build a model. I'm going to have a look at it from fresh, and let's see if we got the right, we're going in the right direction here. And no, egos don't play a part. So we all want the same thing, okay, and that is the best performance for our fund and for our clients.
Okay, thanks. In general, how do you view short interest in the shares you hold? For example, Greggs is one of the most shorted UK shares.
Now, that's an interesting question. So the first thing is we have huge respect for short sellers, okay, and we want to know what their thesis is. And so where possible, we will, look and investigate the thesis. And I have seen that Greggs is one of the most shorted. Now, the other thing is you never know, well, what is the thesis? It's not always visible, but it does force you to go and have another look. Shorting is a difficult game. And in fact, in my career in South Africa at Decillion, I spend a lot of time analyzing on the short side. But also, we also need to understand what drives a lot of the markets is whether, you're always seeing analyst estimates, upgrades, downgrades, and there's a lot of that goes on. Oh, we think the company's going to earn 123, but the analyst estimates is 125, so therefore we're going to short them based on that basis. We disagree with the short thesis on Greggs. Yes, they've got a tough time with they've had a tough year with cost inflation and all the rest. That's easing. Look at things like orange juice prices and wheat prices and energy, etc. So, there's certainly easier candidates. We used to have a saying when I was involved in the short business, it's much easier to short a wounded buck than a charging rhino. Okay, there's lots of companies with far weaker balance sheets, etc., than Greggs, and you just have to look around. It's a compelling value proposition. They're growing. When times get tough, people are going to trade down to Greggs. There's huge growth potential, and so we're not worried about it.
But I think the other note is, are we saying we write in Greggs is cheap stock in the world? No, we're not. we're just giving an example of a stock we own. And I caution people about, cherry picking from our portfolio because we make mistakes just like everybody. So the reason we spoke about Greg's today, it's an example of a type of business we own. Yeah.
Okay, thanks. Given how big and diverse your universe is, do you have a screening process to make the initial investment?
Andrew, you want to go with that?
Yeah, so for sure. I mean, we've got, let's just say there are two core ways that we find investment ideas. The one way is we call about fishing where the fish are. So a good example this year would be South Korea. If you had read earlier this year, you'd have seen articles in the FT saying the Korean investor, there are all these ETFs listing Korea. Korean investors are desperate to invest in America. They were one of the biggest investors in Tesla. They totally abandoned their own markets. That piqued our interest. We were like, if it's hard to invest in Korea and the Koreans want to invest elsewhere, maybe there's value there. So we went and, okay, let's look at just Korea. And we go through the stocks one by one by one. And we found fantastic value in a lot of stocks. Okay. And then we've done that many times across the world, whether it be in Colombia, Brazil, the UK. We look where people are not looking. The second way is we have various screening methods. So we screen on both Bloomberg and FactSet. We run different screens. The things we look for are things like companies that have had a high return on assets historically, which tends to mean they're good businesses. High return on assets, they've been growing earnings, but in a low forward multiple. Or we look for that same thing, but we look for current EBIT margins below 10-year EBIT margins. So they're going through a cyclical bad time. So we cut it lots of different ways and we screen and we'll get down to short lists. I've got lists of short lists on my desk and we'll run a screen. We'll get a short list of 40 stocks. And then I'll start doing more detailed work on each stock. Just go through it. Often something screens up, but you look more carefully. For some reason, you don't like it. Move on. So yeah, we've got screening processes, but we obviously look for stocks. And then when we identify something, we say, Sean, you look at Andrew, you look at Hiren, you look at Korea, you look at it. And then we do detailed work on the company, on the industry, on the management, on the history to try and determine the fair value.
Yeah. Because it's often a question we get asked, with a small team, how can you know all the stocks in the world? And we don't know all the stocks in the world. Okay. It's a bit like saying, how can, Rassie Erasmus know all the rugby players in South Africa? I mean, he doesn't have to know all the rugby players in South Africa. He just needs to know the ones that fit the mold of what they're looking for. If they're looking for a lock, they need to be 6'8". If they're looking for a fly off, they need to be fast, etc. And so that's what we do. We use the screens to screen out those kind of companies and then just focus on those. And so there are lots of large companies we have no view on because they haven't swum into our pond and we're not going to spend time researching those.
Okay, thank you. What are your thoughts on offering a balanced fund or still keeping it the simple one equity fund model?
We're doing our focus on our global equity fund. We think it's as I said earlier, it's a great strategy. It allows us to move around the world. The minute you have more funds, I mean, one of the other things we didn't say today, but I know we have spoken about previously, is we don't desegregated accounts. So even if a large client, family office or whatever said, can we give you 50 million to run on the side? The answer is no, put the money in the fund. Okay, well, alongside everybody, that enables us to have a smaller operational team, operational team, because you've only got one custodian and one administrator and you're reporting back on one fund. You're not trying to reconcile performance. So, you've got one fact sheet. As soon as you've got lots of funds, balanced fund, what's your benchmark, lots of annual reports, fact sheets, different marketing strategy. We just have no interest in getting distracted like that. Andrew, anything you want to add there?
No, I mean, Sean and I won't invest for ourselves. We like to invest in equities. That's what we do.
Yeah.
Keep our life simple.
And if you look at the dividend yield of the fund, it's pretty much what bond yields are out there in developed markets. But as Andrew said, they're growing. So we have no interest in that. Yeah. Okay. And one other thing. As soon as you've got a balanced fund, there's lots of other complications. Like, is the market expensive? Should we have the equity weighting here? Should we move it into bonds? Rather just focus. We're not trying to call the markets. We're just focusing on the opportunities and bottom-up opportunities. Okay.
Okay. What worries you most about markets today?
I guess what worries me is that I think people have become extremely benchmark cognizant. It's been a difficult thing to do, is to beat the benchmark. And so what does that mean? We've become benchmark cognizant. And if you think about it, the benchmarks were created by, well, let's look at the names of them. The Dow Jones, the Financial Times, the Nikkei, they were all newspaper publications. Okay, they designed these benchmarks to explain to the public how the market is performing. Then we started comparing ourselves to those benchmarks, and now everyone's investing in those because it's been difficult to beat those. So it's what was a mechanism for explaining how the performance is now all of a sudden taken as investment advice. And so now you have a huge amount of wealth invested in very concentrated. I mean, you saw the regional weightings in US equities in these large, massive companies where things are changing rapidly. I mean, we wrote about this in the fact sheet in terms of NVIDIA. Only a month ago, everyone thought OpenAI and NVIDIA was the winning combo. That's why everyone was signing up deals with them. And along comes Google or Alphabet with Gemini and their chip. So things change. And so the problem is you've got a huge amount of money in a very concentrated area of the market, which is very dynamic. And that could be problematic. Andrew, would you have anything you want to add there?
In truth, I actually don't spend any time worrying about the market because I don't worry about things I can't change. It's like I think it maybe keeps me young. I do spend a lot of time worrying about our stocks. Because that's an era of commission, buying a stock that's overvalued, or I've underestimated something, or I've underestimated the competition. So I'm always thinking of my stocks. Like, I'm thinking about Diageo, I'm thinking about the competition, I'm thinking about this, because that's something I can do something about. If I can sell it, we can be gone and move on to another stock. I can't change when the market goes up or the market goes down. So in truth, I can't do anything about it, but I can do a lot about our portfolio, and that's what matters to me.
On that theme, Andrew, next question is, how long do you spend looking at a particular stock or idea before making a decision?
Let's say from screening and me working, and then I work on one stock full time, I probably spend, depending on the complexity, 4 or 5 days. I would say, yeah. I mean, so some people would say that's quite quick, but I'm focusing on the one stock, and often we know the sector. Like I'm looking at this morning, I was looking at a Chinese producer of power tools. I've looked at a few of these things, and as I know the market sector quite well, I'm looking at this one, doing research on the management. A few days on each stock before it moves in the portfolio, and then just in terms of the process. So obviously look at it, build a model, and then we discuss it. So I'll present it to our team. We have a meeting every day, and I'll say, I think this company, I think this is a story. It does this is competition. This is what I think normal margins are. I think why. And I do this. And at the end, we come out with what we call an expected total rate of return. So if we buy the company today, we own it for 4 years, what do I think a fair exit multiple for that company is? What do I think we'll receive in dividends? Therefore, what's our expected return? And we're looking for companies which we think will give our investors more than 10% return. And then Sean and I discuss it. We discuss potential portfolio sizing, just looking at risk, balance sheet, etc. And that's how we do it.
Yeah. And if you think about it, many of the things that are absolutely fundamental don't take a long time to work out. What does the balance sheet look like? That's not going to take you months to figure out what the balance sheet looks like. Does the company generate cash flow? Again, it's not going to take you months. We've been doing this for a long time. So things that don't add up when you're looking at the balance sheet or you're looking at the cash flow statement going, well, hang on, if the company, supposedly the cash flow statement says they generated $10 billion of cash, where's it gone in the last 10 years? Where's it gone? Has it reduced debt? Is it sitting on the balance sheet as goodwill? Has it been paid off for dividends, etc.? So, so we will invest. We will spend as much time as it takes to get to a great conclusion. But we're also mindful of the fact that if you spend 3 months looking at a stock and you're wrong, you don't want to let go. There's a bias to not letting go because you think, oh, I've just spent so long looking at this company. How can I possibly confess that I've wasted my time? So, but we will spend as much time. And I guess you look at the number of winners and the number of losers, it suggests that we're okay in that regard.
Okay, and similar on the balance sheet there, Sean. You say SAPI was a mistake because it had debt. Do you have a debt rule, a leverage threshold, e.g. net debt to EBITDA?
Well, also, look, we've seen businesses that report EBITDA go bust because earnings before interest, tax, and depreciation can often look very different to ones after interest, tax, and depreciation. And what about capex? And so it will vary from company to company. And what is your interest cover? We look at EBITDA. You can use operating income, calculate your interest cover versus operating income. We prefer to do it versus EBITDA, but we'll look at a number of different methods there. And also, what is your enterprise value and your debt relative to the market cap? So how much, if you decided you had to have a rights issue, how much dilution are you going to face? So we look at all those factors.
We also look at the margin of safety. So obviously when you're doing a model, you know the debt, that's a fact, okay? They've got a CapEx plan. The big unknown is revenue and margin particularly. So then your stress test, you say, I think SAPI's normal margin, for instance, is, let's just say 11% on average. Okay, what happens if I'm wrong and it's 8? Is it still fine? Or at what point, if you think normal is 11 and debt becomes an issue at 10, then, that's, you're not going to touch that. But if you think normal is 11 and debt becomes an issue at 6, well, that's probably fine. So that's more the context.
Okay, thank you. Is your company selection process a more systematic approach versus visiting the company's executive or management?
Yeah, I mean, we don't meet management. We'll read conference call transcripts and we see what they say in their press releases, but we don't fly around the world sipping coffee with chief executive officers. So, we prefer to evaluate management based on the numbers. What has this company generated in cash and what have they done with it? Have they done good deals or bad deals? Has return on assets gone up or gone down? We think that's far more beneficial than having a cup of coffee and saying, what do you think of the future?
Okay, thanks. Have you exited the Russian names or adjusted the price to 0?
They're priced at 0. We can't exit the Russian names. So they're priced at 0.
What is the reason behind no performance fees?
What is the reason? Well, I mean, when you go to the dentist and you've got a sore tooth and they pull out the right tooth, you don't have to pay a performance fee for pulling out the right tooth. Clients have entrusted their money to us and they've given it to us because they think we're going to generate performance. And so that's part of the deal. And so, other people can have their business models. This is what we do. And the numbers are big. I mean, if you think about this year and the outperformance, you go and take 17% outperformance year to date times 20%, 3.5% times $1 billion. That's a lot of money that we've left in the hands of our clients. And we think that's fine. And so how we look at performance, if we generate performance, we'll get more assets. And on those assets, we'll earn fees. And, we're not out there. I got asked the other day in a meeting, what does the car park look like at Ranmore? And I had to actually ask twice because I didn't quite understand the question. And then I relayed an interesting, a humorous thing where we were talking in one of our morning meetings. And I'd heard about that, we'd seen in a chart that some of the European autos were weak performers. And I typed in Ferrari and I got the R's wrong. And Andrew said, I'm pleased to see you don't know how to spell Ferrari. So, we don't need to, we earn a fair wage. We look after clients. That's what we want to do.
Okay. What kind of planning do you have in place if either of you are to leave?
Well, look, I mean, between us, we own almost 80% of the business. I have no plans to leave voluntarily off this planet. If I did, you've heard today, the fund is in very safe hands. Let's just say that. And I know that my wife wouldn't redeem a single pound of our investments, nor would any of my children. So I have no plans to go anywhere. And we're doing what we love doing in a flexible environment in terms of, like a small boutique not a large corporate with endless bureaucracy. Why do we want to go anywhere else? Andrew, what do you want to say to that?
Yeah, no, I mean, I think we're both quite healthy. We're not planning on dying. And I mean, I've got to invest my savings. This is what I do. This is why Sean and I work together, because we both try to invest our savings. And it comes down to that question, well, why don't you have a performance fee? Well, both of us have all our savings in this fund. If the fund does well, we're very happy, I promise you. I mean, because my savings have grown just like everyone else's. So, yeah, it's like,
Yeah.
Okay. Has AI helped to reduce the number of days required to analyze a stock, or do you see any impact of AI on your investment process in the future?
I mean, I think a few things. We looked at a number of tools. I mean, what we like to do is go and rebuild the historic income statement, balance sheet, and cash flow statement from company source documents. So when a stock has come through a screen, it's okay, let's go and build it from scratch. And we looked at a number of AI tools to see if that could fast track the process. Hasn't really, to be honest. Analyzing conference call transcripts, that's perhaps I found a bit of benefit there. But yeah, Andrew, is there anything you wanted to add to that? In terms of
I use it. I mean, I use Gemini for a few things. Like if I'm looking at Indonesian stock, I want to know who the big Indonesian noodle producers are. And it's hard to find. Like that kind of stuff is pretty good. Like I want to know who the big producers of acetate are in Japan. It's useful for sure, and it saves me time. And yeah, and I think it will become more useful over time. And AI is obviously the kind of big question of our time, and it's extremely important. And will it change industries? Yes. And when we invest in businesses, we're very cognizant of thinking about, as AI improves, what could or would happen to this company's business model. It's something we think about greatly. And yeah.
And I mean, recently I was looking at, a little while ago, a pharmaceutical company. And so you can say the patent portfolio, when are all the expiries? What are the big competition, competing factors? You have a look at the competing drugs. When do they expire? So it does, in that respect, it certainly does. It does help fast track things.
Okay. Now, lots of talk about a crash or correction coming. Do you expect that to happen? And if so, how would you expect it to affect the funds?
I mean, it's just a waste of time trying to think about. There will always be a crisis. We just don't know when. Okay, and there hasn't been a lot of fear in the markets. There's been more greed than fear at play in the markets in recent years, and so it wouldn't surprise us. But trying to predict it, if you knew that in 2019 you were going to have a pandemic, all right, and sold, or you knew that Russia was going to invade and sold, they wouldn't have been good calls. So you had the short-term fall. The problem with trying to forecast markets is whenever it falls, you always think it's going to go further. Okay, and so then you miss the bounce. So, and then because you didn't buy on the first bounce, you think, oh, well, don't worry, I'll catch the second bounce, and it keeps going. And that's why they talk about markets climbing a wall of worry. So just don't waste your time. If we thought, we just don't do that. That's why we got cash where it is. And we just focus on the downside within protection in each stock. Where's the margin of safety in each stock?
Okay. What's your opinion on energy stocks and commodity-related stocks?
Andrew, do you want to talk to that?
We look at them. I mean, we do have Petrobras, and we've got a couple of Japanese chemical producers, like niche chemical producers. But in terms of energy, it's weird. Like the oil price has been very weak and so on, but the big oil companies are actually very strong. Is the outlook for oil good? No, it's probably not great, because for sure electric cars are excellent, solar's growing if you look at emerging markets. So we're quite cautious about that. And then if we look at the kind of commodity stocks, i.e. the mining companies, people are quite excited about them. We don't see huge value. And the other big one is chemicals. So let's call it commodity chemicals. And unfortunately, what's happening in commodity chemicals is a huge capital investment going in, particularly in China. And we tend to be cautious when people are investing huge sums of capital in a sector, because it tends to mean returns will be lower. So that's why I say we own a few niche Japanese chemical producers, and we own Petrobras, which we think is very cheap and got great assets. But other than that, we don't find a huge amount of value in the sector. We may be wrong, but we find more value elsewhere.
Right, we're coming up to the hour is up. Thank you so much again for taking the time to participate. I hope that's been useful. If you've got any other questions that you feel you'd like answered, please email clientservices@ranmorefunds.com. And yeah, Merry Christmas and Happy Holidays, and we'll see you in the next year.
And if I may, again, thank you for support. I mean, we really appreciate it, and we strive to do well. But that said, we will underperform. So, we've had a good period. Not all periods will be good. We will underperform the market from time to time. The important thing for us is real returns over the long term. And that's what we spend all day striving to do. Invest in companies that we think will give our clients real returns. Thank you so much.
Thanks, Andrew. Thank you, Hal. Thanks, Dan.
Cheers.